So first, welcome to our Greenleaf Connect event in partnership with the Greenleaf Foundation. Today, we welcome back our special guest, Jason Ford with Ford & Associates, who will be hosting our fourth and sadly final session in our financial literacy series discussing protection management. We always like to start with a brief explanation of exactly what Greenleaf Connect is. And Greenleaf Connect is a weekly forum for us to be direct, informative, and provide transparency to our audiences about all things Greenleaf. Today's event is a Connect event, which means it's a more private group with videos on and a live Q&A, while our live stream events are for larger groups and open to the public. And for our rules of engagement, first, you can change your presentation view by moving the slider between the presentation and the video to make the presentation or the video bigger or smaller. We do ask that you mute yourself during the presentation portion of the meeting to avoid any feedback as we present. And we will hold a live Q&A session at the end of the presentation, so do think of your questions. And a friendly reminder that this session is being recorded and will be made available via Workplace by the end of the day tomorrow. On our agenda today, Jason will start off with a nice reminder of how money works and the rule of 72. Next, he will give us an overview of income protection. We'll then move into the dimed principle. And we'll end our presentation portion of today with a discussion on the different types of insurance plans. Finally, we'll close out with our live Q&A and some important upcoming dates. So without further ado, I want to introduce everyone to Jason Ford, who is a financial broker and coach with Ford & Associates. Welcome back, Jason.
Thank you so much, Natalie. I'm glad to be back, and great afternoon, everybody. We are here for the last and final session. I'm sad to see it all come to the end, but just know you all will have my contact information and you have access to me whenever you need me. So don't hesitate to reach out, especially as you all are hearing a different recording. So we're going to dive in as we focus on the last and final principle to wealth. And so let me recap. In order to create generational wealth, there are three principles. You can go to the next slide. There are three principles of wealth that you must follow. So they are: number one, you want to save as much money as you can, as fast as you can. So once again, that's put you in a position so that when you're ready to retire, you can live off the interest of your money. The second principle of wealth, I call it good, and that stands for get out of debt as fast as you can, because we learned if we have $50,000 saved, but then we also have $50,000 worth of student loans, credit card loans, or car loans, we have no money. And then the third and final principle that we're going to focus on today is you want to protect the wealth you have not yet created. And when I say protect the wealth you have not yet created, that's making sure you have adequate life insurance in place. So we're going to kind of dive into what we're talking about protecting the wealth. And we have to protect our wealth until we complete principle number one, save, and until we complete principle number two, get out of debt. Next slide. So I always like to recap on how money works. So remember, most people are concerned about money matters, but few truly understand how money works. So your money should be working for you when you're not working, and your money should be working for you when you are working. So we want to make sure that your money is working for you. The hardest thing that should be working is our money. We shouldn't have to go work hard for the money. Next slide. And as a financial coach, I'm always about making sure you become an owner of your money, not a loaner. So I always want to recap this as we get paid, as you're making money, as you're investing and saving. Most people, when we take out money, our hard-earned money, we usually put it into your traditional financial institution like your credit unions and your banks. And let me be clear, I'm not beating up on the banks and credit unions. We definitely need those entities to pay our bills and maybe have an emergency account. But to create wealth is not going to be created in those institutions. Why? Because they usually give us a small interest rate. So if you go to the credit union, your bank, and even as we talk about life insurance today, you're going to notice on some of those life insurance policies, they give you a small interest rate. So what the financial institutions will do is take our money, your money, and invest it into the global economy. And once again, the global economy is anywhere where you and I spend our hard-earned money. So wherever you spend your money, I went to lunch today at Chick-fil-A. So I just provided or gave into the global economy. Now I want to show you how you also could benefit from the global economy. Next slide. And one concept that you want to make sure you remember, if you don't remember anything that I talked about, you want to remember the rule of 72. They call this rule the banker's rule, but I call it the money game rule. Meaning if you don't know the rules that the financial institution play with your money, how can you win in the game of money? Okay, so this rule was made famous by Albert Einstein, and it basically means if you take the number 72 and you divide it by whatever interest rate you're earning on your money, that will equal how many years it will take for that dollar to double. So as you see on the screen, if you have $10,000 and you was able to see a 3% interest rate, 72 divided by 3 is 24. So that means, I'm sorry, 72 divided by 3, yes, it's 24. And that means it's going to take 24 years before that 10,000 double to 20,000. So every 24 years, it will double. But what we're looking for is averaging that 12% or better. So if you look at the 12% interest rate, 72 divided by 12 is now 6. So every 6 years, that 10,000 is doubling. So in that same 48-year period, that 10,000 will have doubled to 2.5 billion. Now, why is the rule of 72 important? Because once you hit your financial independence number, and we talked about that a couple of weeks ago, the financial independence number is a number that you need to have saved so you don't have to go to work. But once you hit that financial independence number, you are now should be in a position where you are now self-insured and you should not need the life insurance. And we'll dive in a little bit more into that today. Next slide. So when we say protect the wealth, I always like to use this example here. So let's say you had this toaster that you purchased, let's say from Amazon, once again, the global economy. And this toaster on the 1st and the 15th of every month, $2,000 will pop out. So that's $4,000 a month will come out of this particular toaster. Would you like the toaster? Absolutely, you probably would. Would you put insurance on this toaster so that you know every single month you're going to have $4,000 come out? Yes, you will. But unfortunately, we all know there's no such toaster, but you are the money machine for your family. So when we say protect the wealth, you want to make sure you have adequate life insurance in place. And you want to have life insurance in place outside of the job. And why is that? Because if we ever decide to leave the job, we retire, or we're no longer there, we're no longer part of the group. Therefore, you don't keep the group benefits. So my wife and I, we got really big in this industry because we were the ones literally, and I'll be upfront, we were the ones going to funeral after funeral after funeral, passing the hat around. And the hat would normally come down my row a whole lot more often because they said, well, Jason, you graduated from college, you have all the money, you should help. And I said, no, that's not how it works. Yes, I graduated magna cum laude from Florida A&M University, but my job is not to take care of you when you pass away. We have to be more proactive. You got to be more proactive than reactive. What I mean by that, we'll put insurance on our cars, our homes, our tablets, our cell phones. We'll even put insurance on the packages we send through the mail. But why is it when it comes down to our life, we don't do that? And I always tell people, GoFundMe is not a life insurance plan. Okay, so you want to make sure you have adequate income protection. And so I always get asked the question, well, Jason, how much coverage should I need in life insurance? Is 25,000 enough? Is 50,000 enough? Well, to determine how much coverage you need, next slide, and life insurance, I like to use, if you go to the next slide, please. I like to use an acronym called DIMED, D-I-M-E-D, where the first D stands for death or someone's funeral. I stands for income. M stands for mortgage. E stands for education. And the last D stands for any personal debt that an individual has. Now, the three main things that I always want to make sure I take care of in someone's policy that I call the bare minimum. You want to make sure you have enough to cover the funeral, enough to cover your mortgage, and enough to cover any personal debt that you have so they don't come back and put a lien on a house we just paid off. And that actually happened with one of my relatives where they were underinsured. We had to come up with money for their funeral, which we did, but they had so much debt that they put a lien on the house and my relative, well, my cousins lost a house and didn't have a place to live. And so I don't want that to happen to anyone that I come in contact with, which is why we got to make sure you have enough coverage. So when it comes out of funeral, I tell people bare minimum, you need about 15,000. Okay, give or take, you need about 15,000. When it comes down to mortgage, I'll just ask the individual, how much will it cost to pay off your house? And whatever they tell me, I'm going to put that in mortgage. Okay. Now, let's say I'm sitting with an individual and they say, well, Jason, we don't own, we're renting. No problem. I always ask the question, you know, God forbid if something happens to either one of you, I don't want the surviving spouse, I don't want the surviving family member to worry about paying rent or mortgage ever again. So if you were looking to purchase a home, what price range would you be looking at? And that's what we're going to put in the mortgage. So for the sake of this example, let's say they own the house and they owe 150,000. That's what's left. That's what I'm going to put in the mortgage. And now when it comes down to personal debt, I'll ask the individual, if I cut you a check right now, both of you, the primary and the spouse, if I cut you both a check right now to pay off any student loans, credit card loans, or car loans, student loans, credit card loans, or car loans, how much do I need to cut you a check for right now to pay it off? Let's say the primary said their debt is 50,000. And the spouse said, well, my debt is 40,000. So combined is 90,000. So why do we combine it? Because if something happens to the primary, I want the spouse to not only pay off their debt, but also pay off the primary's debt as well. Okay, so that's how we calculate the bare minimum. Now, income and education. That is more designed for those people that may have small children, have children still at home living with them. It may be if you have a parent that you take care of. But let's just say for the sake of this, you have small children at home. And when it comes down to income, I usually ask the mom this question. I say, you know, God forbid the father doesn't come home, the spouse doesn't come home, and we paid everything off. So we paid off the funeral. We paid off your mortgage. We paid off all your debt. On top of your current income, as you're still working, on top of your current income at your job, how much extra a month would you need to take care of the kids? Depending on who I'm talking to, I may get a couple answers. I may have one mom that said, well, you know what, Jason, if you pay everything off on top of what I'm currently making at my job, I don't need anything extra. But you may have some individuals that say, I need an extra $500, an extra $1,000, extra $1,500 a month, because maybe their children are in extracurricular activities. Maybe now they got to put their child into daycare. Okay, so let's just say, for the sake of an example, that person said they need $1,000 a month in extra income. So I take the $1,000 and I multiply it by 12 months, which is $12,000 a year. Now, this mom is not going to need the 12,000 once a year. She's going to need the 12,000 every year. So I take the 12,000, multiply it by 10, and that's how we come up with 120,000. So why did we come up with 120,000? Because when the beneficiary, when this mom is receiving this big check, she's going to take 120,000. Okay, she's going to take 120,000 of the check and she's going to put it in a TOD. That's what we talked about a couple of weeks ago. She's going to put the 120,000 in a TOD where she's only going to live off of 10% of that 120,000. Living off of 10% of 120,000 is $12,000 a year. That will break down to $1,000 a month that she'll receive every single month for the rest of her life. Okay, that's how we come up with the income. Now, education, I always tell people, I have 3 girls, 16, 14, and 6. And I always tell people, if I'm here or if I'm not here, I want my girls to go out to college. Now, they may not have to go out of state like I did, but let's say if I send them to a local college. And for the sake of the example, everyone's going to local college, the amount is different, but let's just say for the sake of numbers, it's $10,000 a year. Okay. Most people go 4 years. So that's $40,000. But in my case, that $40,000 will only cover one child. I have 3. So I take the 40,000, multiply it by 3. And so that gives me 120,000 that I need to put in education to make sure if something happens to me prematurely, my girls can still go off to college. Okay. So that's how you determine how much coverage you need in life insurance. Next slide. So which do you prefer? Bank A, Plan A, or Plan B? So let's say Plan A, you keep all your money. That when you put the money in that account, they say, you know what, we're going to keep all your money for the first 3 to 5 years. So the first 3 to 5 years, you can't even touch it. Would you bank there? Probably not. They also stated while your money is there, you're going to earn at max a 4% interest rate. Okay, so we learned based off the Rule 72 that 72 divided by 4 is 18. So that means every 18 years, your money is going to double. Would you bank there? And not only that, they said while your money is there, okay, if you need your money, you can borrow the money. But when you borrow the money, you have to pay it back at an 8% interest rate. So you're telling me I'm earning 4, but I got to pay it back at 8. Would you bank there? And we learned last week, principle number 2 is what? Get out of debt. So why would we want to borrow money that's going to put us into more debt? So you probably would not bank there. They also can hold your money for up to 6 months. And when you die, they keep the cash value. Your family will get the death benefit. You probably will not bank there. But Plan B states your money is credited to you immediately. You have a potential 10 to 12% rate of return. There's no fee to withdraw your money. Why? Because we're going to have it into an IRA or a TOD. You get it whenever you want to get it without borrowing it. You withdraw your money, you get it within 24 to 48 hours. And when you pass away, not only will your family get the death benefit, they also will get the cash because you separated the two. Next slide, please. So that Plan A that I was talking about was cash value or whole life insurance. Usually with cash value whole life insurance, you have a low death benefit, high premium. So in this example, John and Mary has 150,000 each in cash value whole life. Total coverage, 300,000, paying $295 a month. I commended John and Mary for having life insurance. Why? Because 9 out of 10 of us don't have it outside the job. But I said, John and Mary, I noticed you have no coverage on your kids. You do know that sometimes the kids can pass away before the parent. And I know we don't want to have that conversation, but sometimes it happens. So then the next type of insurance I recommended was term. Term insurance allows you to get a bigger face amount for a small premium. So now they have 400,000 each, 10,000 on the kids, total coverage of 810,000, paying $126 a month. So I saved them $169. So guess what? What did I tell them to do with the $169 that I saved them? I told them to invest it in the global economy. Let's say at a 9% interest rate. 35 years later, they have over $500,000 saved, okay? So ladies and gentlemen, remember, insurance is insurance, investments are investments, never merge the two together. You keep them separated, okay? Because with the cash value whole life, you gotta borrow the money. With the term, we're gonna keep the insurance, investment. So if something happens to John in this equation, not only will Mary get the 400,000, she will also get the 500,000 because that's in a separate investment account, Roth IRA or TOD. Okay. Now also, if John and Mary needs any money from that 500,000, they don't have to take out a loan. It's their money, they can go get it. Okay. So remember, insurance and insurance, investments are investments, never merge the two together. I always ask this question for those of us who have car insurance. Can you go to your car insurance company and say, hey, you know what, this month, can you send me $500? No, we can't do that. Can you go to your health insurance company and say, hey, you know what, this month, I need about a couple $1,000s. Can you send it to me? No, you can't do that. Can you go to your mortgage insurance company and say, hey, you know what, I got to get this, I'm going on a vacation. I need to borrow $3,000 from my mortgage insurance. No, you can't do that. So if you cannot borrow money from those, you don't want to get a product, insurance product that you have to borrow money from. Next slide. So here's just an example, real life example. Let's say we have a couple, and they both bring home $3,500 each, which is $7,000 a month. If something happens to the husband or the father, what will happen to that mom and that child if they don't have adequate insurance in place? She's going to struggle. So it's very important that you have enough protection in place so that that surviving spouse don't have to struggle. Okay, do not have to struggle. Next slide. And just another example of cash value whole life, different names for it. It's universal life, variable life, they're all the same thing. Okay, so in this example, let's say John and Mary has 100,000 each, and their monthly premium is $225. And let's say their cash value is $76,880. So if Mary passes away, John gets to pick either the death benefit of $100,000 or the cash value of $76,880. More than likely, what is John going to pick? 100,000 because it's greater. So now the question is, what happens to the 76,000 that's in the cash value? Well, that goes back to the insurance company. Your family don't get it. The insurance company gets it. Now, let's say they borrowed money from that 76,000 and they never paid it back, and one of them passes away. Well, the beneficiary will receive what the death benefit is minus whatever they borrow plus any interest and fees. So you don't want to do that. But on the term side, we say, hey, John and Mary, you get 250,000 each. You're only paying $80 a month, which I'm saving you $145. You now invest that $145 at a 9% interest rate. Now, in a separate investment account, you have over $265,000. So now, if something happens to John, Mary does not only get the $250,000 in the term policy, gets the 200. Never designed to be an investment account. An investment account was designed to be an investment account. Okay, next slide. Okay, so now we're going to talk, and we're almost done here. We're going to talk about the theory of decreasing responsibility. So when we all were born, everyone on here, even your children, we were all born with two estates, a living estate and a dying estate, a living estate and a dying estate. So that kind of blue looking curve is what we call your living estate. The living estate basically means in your earlier years, you may not have a lot of money saved. But as you get close to your latter years, as you get close to retirement, you better have money. You should be averaging 12% or better, so you better have money. But in our earlier years, we may have people that are depending on money we don't have saved right now. So you may have young children, high debt, a mortgage. So a loss of an income will be devastating. So with the living estate, you must build in what we call a dying estate. And that dying estate is the life insurance, which is going to be that green curve. So in your earlier years, you may need a lot of coverage. Why? Because you don't have enough money, a lot of money saved up. But in your latter years, as you get close to retirement, you should not still need to have that much coverage in life insurance. You should really need little to none. Because why? In our latter years, your children should be out the house. Okay. Even though I hear they come back, they should be out the house. Your debt should be little to none. You should have no debt. Why? Because I'm going to show you how to get out of debt in 3 to 5 years. Also, your mortgage should be paid off. As long as you don't refinance, your mortgage should be paid off. So therefore, if you're sitting on your financial independence number of 500,000 or $1 million saved, you shouldn't still need a $250,000 or $300,000 life insurance policy. You are now in the position to be self-insured. Okay. we'll go on to the next slide. All right, so as I wrap up, I just want to highlight a few stats when it comes down to those three principles of wealth. So the first principle was save. So just remember, nearly 30% say they save less than $25,000. So 30% of Americans have less than $25,000 in their savings or investment account put away for retirement. Okay, I'm going to show you, I've been showing you over the past few weeks on how you could not make sure that is you. Okay, also, almost half of Americans say they worry they will run out of money in retirement. And that is a true statement. You have some individuals that are outliving their retirement money. And why are they outliving their retirement money? Because their money is not growing as fast as they're pulling it out. Because one thing I always been teaching was you want to live off the interest your money is earning. So if your money's averaging 12% or better, you live off of 10 or 9% of that. But it's hard to live off the interest of your money if you're only seeing a 3 or 4% interest rate. Okay, so you got to make sure that your money is working for you and not you working hard for the money. Next slide. We also said the second principle of wealth was getting out of debt. Okay, you want to get out of debt as fast as you can. So the average American has $90,000 in consumer debt. So that's credit card, personal loan, mortgages, auto, student debt. Okay, so we want to make sure you're getting out of debt as well. And more than 1 in 3 Americans say a purchase of $100 or more will max out their credit card. So we focused on that debt last week. And then the next slide. We focused on today that third and final principle of wealth, which is protect the wealth you have not yet created. And nearly half, 46% of Americans have no life insurance coverage in place. This was as of 2020. About 60 million American households are either underinsured or uninsured. Underinsured or uninsured. And we went over today that dined, so you can take a good picture to see if you're underinsured or not. And if you currently already have life insurance outside of your job, just know I can do a free complimentary review just to make sure you know exactly what you have. Because believe it or not, there's some people think they have term, but it's whole life. Some people think they have whole life, but it's term. Some people are not sure what they have, and it may be accidental death, okay? And the average life insurance coverage gap is almost $200,000. Next slide. So as I wrap up and we end our last session, just remember the vision of change that I have. I want to save millions of families from financial ruins, the families that the large corporations do not care about. I want to help them protect their families, get out of debt, and learn how money works. So at the very least, we'll put in the chat my calendar invite. Feel free to schedule a one-on-one with me. And you can either go to the calendar invite or you can reach out to me via my cell phone number, 678-362-1160, or you can definitely email me as well. And I am truly here to help as many people as I can be in a position of wealth. I want to thank Greenleaf Management for giving me this opportunity over the past 4 weeks to be able to pour into you all and just show you that there is hope. Just know financial independence is right around the corner. I guarantee you now in the world of finances, I can't guarantee, but I guarantee you, if you follow those 3 principles that I've been talking about over the past 4 weeks, you and your family will create generational wealth. So that's all I have. I'm going to pass it off to you, Natalie, to see if we have any questions.
Great. Thank you, Jason. We certainly appreciate you sharing this information with us today and over the last couple of weeks. Your efforts have been amazing, and we've certainly learned so much. And of course, we want to thank all of you for joining us as well. This does conclude the main portion of our presentation, but before we dive into our Q&A, don't forget to use Jason's calendar link that he's going to post in the chat box for us. Again, this is free of charge to you, and so please check that out. It'll also be on the workplace post that we have tomorrow. So we do have a few pre-submitted questions like we always do. Once we work through those, you can use the raise your hand feature located under the reactions button at the bottom of your screen and unmute yourself to ask Jason any other questions that you have. Okay, so our first question, how many years do you recommend we have for the term life insurance?
That's a great question. So when it comes down to the term life insurance, I can do anywhere between a 10, 15, 20, 25, 30, or 35-year term. And typically, I want to have enough coverage in place to get the individual to retirement age. So the legal retirement age is 59 and a half, we'll say 60. So what I'll do is I'll take someone's age, let's say an individual is 40, so 60 minus 40 is 20. So I will probably recommend them a 20-year term while we're also working on their investing, coaching them on their 401k and or doing outside investment accounts. So usually I take 60 and subtract it from their current age to give me an idea on how many years the term should be for.
Okay. And what happens at the end of the term?
Yep. So at the end of the term, once the term ends, the client with my company, you are guaranteed renewable. So your policy will be guaranteed renewed until you turn age 100. So you will have the policy until age 100. And then you have a couple options. The first option is you may come to the end of the term and say, hey, Jason, we did what we said we was going to do. I have enough money saved up. I don't need the life insurance. That's option number one. The second option states you want the premium to stay the same. You don't want the premium to go up. So the premium will stay the same, but what happens is the death benefit will go on what we call a decrease in term. But while that's decreasing, your investment should have been increasing. Okay, so the premium will stay the same. The third option will be, well, I don't need that same amount of coverage that I started off 20, 30 years ago. I may need less. So we'll adjust accordingly. And then finally, if you want that same amount of coverage that you had 20, 30 years prior, we can give you that same amount. We have what we call an end of term rider, and we have discounted rates basically for our existing clients. So long story short, you will be covered till you turn age 100. But my goal is to put you in a position where you're going to be self-insured because you have money saved.
Makes sense. So how do the child policies work?
Yes. So with my company on a child policy, a child can be a rider on that person's policy. And so a child rider is for any child under the age of 25. This can be your child or your grandchildren. Okay. Anyone under the age of 25 can be a rider on their parents' policy, and you pay one price for all the children. So for example, let's say the minimum I could do on a child is 1,000, the max is 50,000 as a rider. And let's say they did 15,000, which is typically enough, God forbid, to cover a funeral. That's approximately $9.25 additional a month. But that $9.25 is not per child. The $9.25 covers all the children, grandchildren under the age of 25, and they all will get 15,000 each. Now, once they turn 25, they will come off of their parents' policy and they will get their own adult policy. And when they get their own adult policy, we're going to guarantee them 5 times that amount of insurance without going through underwriting. So no questions asked, no physical, no medical records being pulled. They'll be guaranteed 5 times that amount. So basically, if they had 15,000 times 5 is 75,000 minimum is what they're going to get in life insurance, no questions asked, and that will then be on a 35-year term.
Okay. Does a child's age impact the rider cost when you add them as long as they're under 25?
No, so it doesn't matter the age, no matter their age, as long as they're under 25, each child cost is the same, no matter the age.
And does the child have to live in your household?
No, they don't.
Great. Now, what if your company provides a life insurance policy that covers 1 year of your income? Do we still need additional coverage?
That's a great question. Yes, you definitely want to have additional coverage outside of job, because as I mentioned earlier in the presentation, in the event that you decide to leave your current employment, you're no longer part of the group, you don't have the group benefits. Let's say you retire. You now leave the company and now you retire, you're now older, and you start looking for insurance, then it's going to be costly. So it's best to go ahead and get it outside of the job, number one. Number two, to answer your question, yes, one time the salary typically is not going to be enough to cover, if we do that dined, one time your salary may not be enough to cover the responsibility that's going to be left behind if something happens to you. So therefore, you're going to need more than one time your salary. And once again, I'm big on financial independence. Therefore, you want to make sure you have an independent policy outside of your employer's policy.
Okay, our next question. Does the life insurance beneficiary get taxed on the money that's paid through the policy?
That's a great question. No, all life insurance death benefits are tax-free.
Okay. If you have a death certificate, do debtors forgive debt? Like, can they go after your life insurance policy?
So some individuals think that when the individual dies, that their debt dies. And that's not the case. Yes, they can come after your estate. And that happened with one of my own relatives where they were literally, like I said, underinsured. And since they were underinsured, there was not enough in life insurance coverage to cover the debt. So what they did was, the people that they owed money to, they went in and took the house. So individuals think that, well, when I die, my debt dies with me, and that's not the case. Now, can they go get your policy? No, but they can come get other things so they can get their money that you actually borrowed. So you definitely want to make sure you have enough life insurance to cover your debt, so they're not coming back and taking things from your family.
Now, what about student loans? Do those get dismissed upon death?
That is a great question. So if you have a federal loan, yes, that will be dismissed as long as you show the death certificate. So federal loans are loans that are backed by the government. But if you get a private loans is up to that lender if they want to wipe out or cancel that debt. And so private loans are backed by your banks, your credit unions, and other financial institutions. So it depends on them if they want to honor that death claim and wipe off the debt. Federal, yes, it's gone. Private is up to the lender.
Okay, two more questions. One on the beneficiary. So if the beneficiary is not a U.S. citizen, are they taxed if receiving death benefits for a spouse at all, or maybe more?
No, all life insurance claims are tax-free.
Okay. And then are you responsible for your children's debt if they were to pass away?
If you were a co-signer, yes.
Okay. Now, does
so if
mortgage...
you co-sign on it, oh, I'm sorry. Yeah, if you co-sign on any type of their debt, then yes, you are responsible for the debt. But if you didn't co-sign on anything, then no, you're not. You as a parent are not responsible.
And does mortgage insurance cover paying off the house in case of death?
So a great question. So mortgage insurance is designed to protect the mortgage company. And so when it comes out of mortgage insurance, so let's just say someone purchases a home for $250,000. So the mortgage insurance is going to be based off of $250,000. And let's say that individual passes away and what's left on the mortgage is $50,000. So that $50,000 is going to the mortgage company because they want to make sure they're going to get their money. That's why they have mortgage insurance. That $50,000 will go to the insurance company, the mortgage insurance company, but that extra $200,000, your family doesn't see that. So what I recommend is getting you life insurance and have enough in there to cover the mortgage. So now in this example, let's say the house you purchased was $250,000. And when the person passes away, they owe $50,000 left on the house. When they get the life insurance proceeds, you're going to take that $50,000, pay off the house. That other $200,000, you can now invest it. So now it's working for you. So mortgage insurance protects the mortgage company. Therefore, if you have life insurance, it's usually, sometimes you don't even need the mortgage insurance if the life insurance can cover the mortgage.
Now, how do you feel about prepayment of a funeral?
That's a great question. Prepayment of funeral. funerals, if you prepay for a funeral, all that's going to cover is actually the funeral. Therefore, if you have a spouse or you have kids that are left behind or other debt that you have accrued, now it's going to be a struggle for that surviving family member to figure out how to make ends meet if all we had was a prepaid funeral. And not only that, let's say they prepaid for their funeral 10 years ago. The rates on funerals probably has increased along that time. So you may still have to come out of pocket. And so if you have the life insurance in place, the life insurance, you should have enough to actually cover the funeral so that you don't have to really prepay in advance for the funeral.
Okay, let's say it's just us. We don't have any dependents or a spouse. Do we still need life insurance?
That is a great question. I would say yes. If it's just you, no spouse, no dependents, if you have some loved ones that you want to put in position to see wealth, if you're no longer here, if you have nieces, nephews, parents that you want to leave behind so they're not starting off at a negative number, I would say definitely have the insurance in place. When I was approached for life insurance, I wasn't married. I didn't have any kids. But the gentleman asked me, he said, well, Jason, do you have any plans of getting married and having kids? I said, yes. He said, well, now is the best time to get the life insurance while you're still young, good health, because it's cheaper. So even if you have no one depending on you, if you want to leave something behind for nieces, nephews, parents, that would be a great way to leave something behind by making sure you have adequate life insurance.
And if we meet with you for the one-on-one coaching, you can help us find the appropriate policies based on our needs at this time and then also in the future.
Absolutely. So I will sit down and cater a policy specifically for your needs and your family needs. And we'll put you in a position so that you have the right amount, the right level term, and also look at what your investments are doing or can potentially do in the future.
And last but not least, how do coverage rates change with age? Meaning, should we get it before we think we need it to get cheaper rates?
Yeah, the younger we are is the best time to go get it. Not to say if you're not in your 20s or you're not in your 30s that you shouldn't get it. You should still get it if you're in your 50s, 60s, 70s. But the sooner you can get it, the better, because it is cheaper the younger you are. But I'd rather you have something than nothing. So to answer your question, yes, you want to get it while you're fairly young, because the cost of the insurance is a lot cheaper than as we get older, it gets more expensive.
Great. Well, those are all the pre-submitted questions we have. We have on the screen some of our upcoming important dates. Again, this recording will be made available via Workplace tomorrow. And then next Wednesday, we have our next Tiny Pulse question. If you didn't answer the Tiny Pulse question from this week, please definitely do so because it is on Kudo and we'd like to gauge your interest in that program. And then on Monday, the 14th, Valentine's Day, we're going to have our monthly birthday and work anniversary celebration for February. And then also a special social hour with our commercial team that you won't want to miss. We'll be posting information about that tomorrow as well, and you'll receive the calendar invite. And then on Friday, February 25th, we have our Unearthing Farm 1-year anniversary celebration at the Unearthing Farm off Memorial Drive. You should have received a calendar invite for that yesterday, and also more information was posted on Workplace. And for our Greenleaf Connect schedule, today we held our final session in our financial literacy series on protection management. And then next Thursday, we kick off our February series with our first session on tax-related items with our very own Greenleaf tax accountant, Brian Muai, who will have some great pointers for us before we file our taxes in April. And then on the 17th, we're going to have a Black History Month celebration and discussion on diversity and inclusion with Julius Thomas, and he's the CEO of the People's Uprising. Then on the 24th, we have the Greenleaf Foundation and Philanthropy overview with Vonda. You won't want to miss that one. And last but not least, a reminder on our new professional development partnership with a company called Kudo. You should have received your logins, and we hope you take the time to go into the system and check out all the available courses there. Again, if you didn't receive your login email, just reach out to me and I'll be happy to get you set up. The program, again, is free of charge. You have your own online account with access to over 800 courses. If you've already logged in, make sure you go to My Courses in the system, and that will list all the free courses available to you. And best of all, there is a Greenleaf completion incentive program for the courses that you do complete. And just stay tuned for more information on how that incentive program is going to work. Thank you all again for participating in today's session, and we look forward to seeing everyone next week for our tax review. Thanks again, and have a great day.